Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Okay, well, hello everyone and welcome to the Millionaire Next Door podcast. I'm Robert Curtis, a certified financial planner with a registered investment advisory firm called Signature Estate and Investment Advisors. We specialize in very custom asset management. We give clients the ability to weigh in. They get sort of the say-so in what they go into, not like a cookie cutter, just take it or leave it. But that's been really successful for us and for some folks where that's a really good fit. Today, I have a couple terrific guests. We're going to look at the world of VC, venture capital, kind of a niche area. But I have a couple of folks from StepStone. As you may recall, we had their CEO, Bob Long, on a few episodes ago covering all their products. This is sort of a niche area, but we've got Stephen West. He's a managing director from StepStone. And we've also got Anthony, just meeting Anthony, but it's a Giambrone. I hope I'm pronouncing it correctly. But welcome, guys. Thanks for being here.
Thanks so much for having us, Robert.
Yeah. And I got to preface real quick. We'll get into it, but we were just talking about this incredible weather. Most of the country, this is late January as we record this, and they just went through a deep freeze. We had horrific fires in Altadena, California, and in Pacific Palisades. I think 8,000 and 10,000 people both lost their homes. So that's a little bit on our minds, but we're going to keep charging through life, and that's what we do. Why don't you introduce yourself and give a quick little history maybe of Greenspring, StepStone? Go ahead, wherever you want to take it.
Yeah, happy to lead off. So once again, Anthony Giambrone, Managing Director on the Venture Capital and Growth Equity team at StepStone, and happy to provide a little bit of a history on our platform and how it's evolved. But if you go back in time, what was Greenspring? So the firm that was ultimately acquired by StepStone. We were born and incubated inside the halls of T. Rowe Price. This was in the late 90s by a gentleman named Ashton Newhall. So kind of have always had a very institutional DNA in our firm. We spun out in 2000, and the goal was to be a comprehensive solutions provider, ultimately offering access and allocation to elite VC funds and companies, not just in the US, but on a global basis. And how we executed on this was really unique and differentiated if you go back 25 years. And that was through what was a fully integrated investment platform. So offering dedicated strategies for fund of funds, directs, companies, as well as secondaries. If you fast forward 20 years from 2000, StepStone ultimately acquired Greenspring. That deal closed in September of 2021, and that made us one of the largest global allocators to the venture asset class, where we're deploying, $5 to $6 billion a cycle into funds alone. As you look at the platform today, exclusively focused on VC, we're close to 25 billion in AUM, have around 150 people on the team, and there's about 80 of us that are exclusively focused on research and investments. So, the combination has really provided us with obviously a great platform in StepStone, but incredible global reach. We're in probably 16 countries, 26 different cities that we have offices, and also have now very advanced capabilities in data analytics and technology. So it's really been a wonderful marriage between the two firms, and we're excited about how we execute in the asset class today.
That's great. Our research department is pretty extensive and does a lot of due diligence. So we've looked into you guys a lot, and that's why we have access to the platform. But let me take a quick step back and ask you a few questions. Can you maybe differentiate, just for the listeners, between private equity and venture capital, and then why would an investor want exposure to venture capital?
Yeah, It's a great question. Venture capital at its core is providing equity financing into high growth private companies. So technically, it is a subset of venture capital. When most people say private equity, what they mean is buyout, where you're using debt to acquire a company and then using the cash flows from that company to pay down that debt. In venture, oftentimes these companies aren't generating profits at the time of the investment, and so that's why it's a bit of a different asset class, but it plays a crucial role in the innovation economy by supporting companies that drive technology advancements and economic growth through differentiated products and services. So some of the largest companies in the world, Apple, Google, Microsoft, receive most of their early external financing from venture capital. And it actually has a really large impact on the US economy. There was a study from Stanford that nearly 40% of employees at US public companies founded after 1979 worked at firms who had received VC investment. So, I don't think it's controversial to say that venture is a significant contributor to US economic growth. The second piece of that is then like, well, why would you want exposure to venture? And number one, it's the returns first and foremost. So according to industry data, venture is the highest performing asset class over the last several decades. This is one of the reasons that other long-term investments like endowments and pensions have increased their allocation to venture capital in particular. Another piece is that many Americans kind of have a sense for what their likely timeline for their capital needs will be for things like retirement. So an investor can use their long time horizons. I'm almost 40. I'm probably not going to retire for another 25 years. I can use that period of illiquidity to invest in venture capital where I don't need that capital today. So simply put, most people don't need the daily liquidity that you have in the public stock market for 100% of their portfolio, and may benefit from taking some of that illiquidity premium of the private markets and venture in particular. And then just the last piece is that the universe of public companies has shrunk materially over the last couple decades. Companies continue to stay private longer as well. So a company, HubSpot, went public in 2014, for example. The revenue for the year prior was 77 million. There's another company, Klaviyo, went public, venture-backed company, went public in 2023. Its revenue for the prior year was 472 million. So a meaningful multiple of what was required to go public 10 years prior. And so there just is much higher bar for companies to go public, meaning a lot of the growth and investment gains are then staying in the private markets. And if you're only investing in the public markets, you're missing out on that.
Right. No, that's terrific. And so would you call it a slightly kind of higher risk, higher return, but also through your process, you've made it much easier for folks to access without all these challenges and tax issues and capital calls. I don't know if you want to comment on that real briefly, and we'll keep going.
Yeah, certainly. A product like Spring, I think, is interesting in that historically venture was an asset class reserved for only institutional investments or the richest Americans. And over time, we've been able to develop products in line with the SEC that, again, offers these 40 Act vehicles, which provides a quarterly liquidity. So a bit of an off ramp. Again, this isn't a strategy where you would want to jump in and out of. But if 5, 7, 10 years down the line, you'd say, hey, I would like to access some liquidity and I'd like to have exposure to this asset class as well via a 1099 instead of a K1. Again, it just makes it more accessible for the average American rather than the requirements that many institutional investors or the wealthiest Americans typically had to go through to invest in venture capital previously.
No, that's great. Love that. I mean, the podcast is the Millionaire Next Door. I call it the overnight 25 or 30-year success stories. So obviously day traders need not apply here. It's not appropriate. Maybe talk about, you mentioned how it's such a dynamic piece of the whole economy, right? But it's not often seen, or most people may not be aware of it. How is VC today different than it was 10 or 15 years ago?
Yeah, happy to take it. And it's a great question, one that we could probably spend the entirety of the conversation on. But if you really come at it from a macro lens, I think the blocking and tackling of venture remains the same, and that's equity financing that's in search of very bold and daring entrepreneurs that want to put a dent in the world. But what we see ultimately happening is, as Stephen mentioned, it's no longer just an asset class for endowments and foundations. We're now seeing sovereign wealth funds, both public and corporate pensions, insurance companies, hospital systems, family offices. And then, as we've discussed with Spring and our other solutions at StepStone on the evergreen side, really purpose built for private wealth. So it's really been a more democratized asset class, in particular in recent years, but something that we think is really exciting for a number of investors. The other thing I would say that we have seen is that as a part of PE allocations, venture is now representing a much larger percentage of people's wallet share within private equity. So if you look at the kind of 2008 to 2010 era, venture was probably 15 to 20% of total PE allocations in institutional portfolios. If you look at that same number today, venture is probably somewhere between 30 and 35%. So, has really become a much more meaningful part of people's allocations and portfolios within the private market. And then the third point would really just be the absolute scale. We have seen venture grow from a cottage industry to now being a fully institutional asset class. If you just look at venture AUM, it is 10x in the last 15 years, and it's now around $3.3 trillion or more. So it's really eye-opening. But at the same time, the magnitude of the outcomes that we're seeing is much higher. And, I think that is because we've seen companies have an ability to stay private longer, given the availability of capital. And this has opened up some other avenues for strategies like secondaries and things like that. But it is pretty interesting to think about how things have changed in just a very short 10 to 15 years.
Yeah, so interesting. And then how is the product or Spring as a process? How has that changed access to venture capital over that time?
Well, one thing to consider with a product like Spring is that, as I mentioned, a lot of these companies are staying private for much longer. And so there's a whole range of, if you're investing at the earliest stages, and we have strategies that do that, where it's two individuals in a garage, kind of the classic Silicon Valley idea, but all the way up to companies with meaningful revenues, 50 million, 100 million, sometimes much more than that. And so what a strategy like Spring is doing is often investing into much more mature companies, which, if you rolled the clock back 20, 30 years, they may have been private businesses. People may recall that Amazon went public, I think in '96 at like a $400 million market cap. And that's just not happening today. You sort of need to be a 4 or 5 billion plus business to go public. And so Spring is providing access to those style of companies. And it's in the same process that we are investing into companies with our institutional funds. And so there's a very similar, the same motion really, as we're evaluating opportunities for a strategy like Spring, as we do for our institutional funds, which oftentimes sit side by side.
That's great. I love what you mentioned, the democratization. That's a theme we've emphasized, and how it used to be large endowments and sovereign wealth funds and hospitals and big institutions, but we're seeing more people get access to these exciting ideas. I think probably this is the most interesting part of the podcast for me, is just what you're seeing in VC now, sort of the excitement around the innovation taking place, as in space exploration, AI, military, technology. We're really living in a golden era. I mean, when SpaceX, the rocket went off, they returned it versus letting all the pieces go out into space, and they landed it on the same platform. Or I see other stuff like wearables, like the Oura Ring and things like that. There's some really game-changing stuff that's all around us. that typically folks have not had access to. What are you seeing? Talk about that. Maybe give some examples of things you've actually been involved in and what you see coming. Love to hear your thoughts.
Yeah, yeah, happy to kick off, and we'll let Stephen weigh in as well. But I think we would first acknowledge that the asset class has had a very big transformation over the past few years. If you go back to the end of 2020, probably through the first quarter of 2022, when we were kind of in the ZIRP era, there was a lot of frothiness, and that was probably a point in time where post Q1 of 2022, we saw a really healthy reset in the asset class. There was a lot of tourist investors that had come into venture, and we have now seen a lot of those investors leave, and in turn that has meant that valuations are more rational today, more in line with historical averages. Venture fund sizes have normalized, so kind of like net, when you put it all together, we feel like the case for venture returns is very strong today relative to actually going through that reset. And at the same time, when you really think about where we're at with respect to the next innovation wave, which if you've been paying attention to the news, obviously a lot of people are talking about AI and have been talking about AI probably since OpenAI released ChatGPT, back in November of 2022. That was kind of a watershed moment. There's really been no shortage of opinions on what this opportunity might be. Some might say that things are overhyped. Others might say that it is actually underhyped. But what we do know is that in every platform shift and innovation wave, so for example, internet, mobile, cloud, et cetera, they've all benefited from the waves that came before them. And eventually each of those waves have been larger than those that preceded it. So, I would say we are very optimistic. We're very excited about what's happening in AI and in other types of deep tech and hard tech.
We are really living in an incredibly interesting time, and AI is sort of taking up all the oxygen of everything, right? But it's enabling things like drugs and biotech, and they can figure out the proteins faster, or things like the sequencing of the genome that used to be millions of dollars right now can be done for $500 or something like that. So love to hear some other stories, some examples of how maybe you're getting in on this, maybe either success stories or things you see, or I don't know if you have some more thoughts around that. I don't want to put you on the spot, but it's just really interesting. We are living in a very golden age where I grew up without a cell phone. I don't want to date myself, but in college, I think one person had a computer, in the dorm room, right? The engineer, but it was really crude. So, whoever would have thought. So keep going.
Yeah. I would say, I think if you think about the opportunities in AI, you would probably say there is a stack. And within that stack, you kind of have the infrastructure layer, where you might look at a company like NVIDIA and say they've obviously been one of the largest winners thus far. And then you start moving up the stack and you start looking at the foundational models, and you would be thinking about companies like OpenAI. You would be thinking about Anthropic and their partnership with Amazon. You would be thinking about Google. You'd be thinking about Facebook. And then obviously in the news just this week, the markets have obviously reacted quite a bit to what's happened with DeepSeek coming out of China. And I think at the model layer, our view at least is there probably will be a very small number of winners, but where we really get excited with at least where we see investment going in venture is attacking things at the application layer. And so it's kind of saying, how do we take this model and how do we add value either in an enterprise or in some consumer application or in a healthcare application, like with what you were mentioning with kind of gene sequencing or other things like that. And so, as we think about getting exposure in our portfolios, we kind of love having these strategies where you can get very diversified exposure. You can get a lot of different shots on goal. I would say it's still very early innings. We're not ultimately sure which of these companies may break out. I think at the model and the foundational layer level, that's probably somewhat known. But we're still in the very early innings of seeing companies scale and mature at kind of the application layer. But when you look at the history and the story arc in venture, where you've really seen a lot of winners, where you've seen multi-billion-dollar outcomes or decacorns even, so companies that could be worth $10 billion plus. A lot of those companies have been application layer companies. And so, as we invest today, those are the stories that we're finding ourselves really excited about. And while it's still early, certainly a lot of companies are very promising. So we'll maybe kick it to Stephen if there's anything else that he would add on top of that.
No, you said it.
Well, it's so interesting. I know the whole DeepSeek thing hit yesterday, right? NVIDIA took a big drop, but was talking to a client. I looked back. I think he was up 2,800%. I told him to quit slacking off and, try a little harder next time. But there are those ideas, and that wasn't even a company all that long ago. And the market has gotten, as you probably know and listeners may know, very, very narrow, right? With 5 or 7 companies in the public space. So this is a chance to get into other spaces, a little more diversification, but to have a team of experts like you guys at sort of the front edge looking for this thing and try and carve out some allocation for folks, I think is hugely valuable. And, what we do is help guide that process too. So put you in touch with folks who really, and a team that's best in class and is always doing it. I think that's a really valuable process for clients. So, Stephen, I know you wanted to chat. There's a little chat note. Jump in maybe on DeepSeek and NVIDIA. Go ahead, please.
Yeah, I just think it's a helpful reminder as we look at a lot of, many Americans have their 401k in the S&P 500. And so you look at, as you mentioned, like the narrowing of the universe where the top 5, top 7 companies continue to make up, plus or minus maybe a third of the market cap. And you have a company like DeepSeek with its model release, take 10% off NVIDIA. And I think it's just Mark Rowan from Apollo last year was one of the comments that he had, just as thinking about the public markets and the private markets, is like, we have so much of the American retirement levered to NVIDIA. And you're kind of seeing that today, or over the, past couple days. And so that's where we think something, a strategy that provides access to venture capital could be interesting for folks, is that it provides a diversified exposure to the category, and is maybe not as sensitive to one kind of piece of news like this. So just like I think just a helpful data point as we've been looking at the market and why someone could consider a 40 Act fund within venture capital as a portion of their retirement or overall investment portfolio.
Yeah, that's a super good point. For example, a lot of folks, their biggest asset, might be their 401k or their, defined their pension plan or cash balance plan. They're not going to have access to those things. So they are going to be incredibly concentrated in NVIDIA. I get a lot of client questions. Hey, do I have any exposure to that? So maybe they have direct exposure, but I'm like, absolutely, you have exposure. If you have Vanguard, this or that, you have a Growth Fund of America, and people are probably much more concentrated or levered in that thing than they realize. And this offers different opportunities for things they'd never get exposure, all kind of guided in a custom strategy that's accessible and easy to work with, and with minimums that working through a firm such as ours where we vetted it, I kind of think of it like this. If it's a new journey for folks, if they're not constantly in there, it's kind of like summiting a big mountain or Everest. You want that guide. You want that Sherpa or whatnot. I'm told it's not even summiting. It's descending the thing is more challenging and higher risk than ascending it. You only spend about 15 minutes up top, but you have this guidance from someone who's done it. hundreds of times, and you want that in this space, and that's what you guys provide. And in a partnership with what we do, we just think there's a lot of value and a conversation and discussion. So with all that, I'd like to turn it back to you two for any closing thoughts, maybe anything we didn't cover or other salient points you feel like would be good to share with folks.
Yeah, I was just going to say, we philosophically agree with everything that you were saying, Robert. Venture, at least in our minds, has been and always will be a very relationship-driven asset class. We eat, sleep, and breathe venture every day, and I think we all feel very grateful and blessed that we get to work with some of the best venture funds and some of the best general partners at those funds around the globe. And it's really through those very deep relationships, some of which span several decades, that we find these great investment opportunities. So I think it's really a privilege of ours to be able to work on a platform like this, and to ultimately to be able to partner with investors who may be coming into the asset class for the first time. But those investors are kind of getting to work through a platform like StepStone, and gaining access to these institutional opportunities that they otherwise couldn't. And I think, for us, when we wake up every day, we have a ton of energy about the work that we get to do, and inevitably get to see some of these companies make headlines, which is obviously very, very satisfying. So we're super excited about the opportunity to tell more of the story to your audience, and really, really thankful that you've had us on today.
That's great. Yeah, I am too. I think it's a really exciting journey, seeing what's coming down the pipe and what's going on, because we all know there's a lot of stuff changing these days. So I really, really appreciate it. And folks, this has been a great summary. This will be an evergreen resource for anyone. You can reference it back. It's not really just locked into today's date. If you have questions, please reach out to me. We've been really blessed to have a partnership with StepStone and their expertise, and we walk clients through that, kind of like that shaman. So super exciting. We appreciate you taking the time, and love the reference to those videos. That's really interesting stuff, and wish you guys a great day. Unless there's any other closing thoughts, I just want to thank everyone for listening, and Stephen and Anthony for taking the time to be here. It's been terrific. Thank you.
Thanks,
Robert.
All right, everyone. Make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, LLC, member FINRA SIPC. Investment advisory services offered through SEIA, LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.